Is there anything coherent about Trump's economic policies?
The lesson of all of this is that bullies do actually prosper. Bullying wins. It's a successful tactic.
It's all about deregulation, allowing infinite amounts of created new money, whether it's in crypto or the lower interest rates, to just slosh through the system.
There has to be a greater focus on inequality because that's what gives rise to a lot of the populism that ends up being so corrosive to long-term economic growth. There has been a certain element of every man for himself after the announcement of the global tariffs. Individual countries have fallen over themselves to try and strike bilateral deals.
If Trump's threat of haphazard tariffs is not enough to get the EU to become truly a United States of Europe with a unified economic approach, then nothing will be. I'm Jason Pack, and this is Disorder, the podcast where we try to find a semblance of order in our mad, 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 mad world. You might be shocked to find out that one semblance of order of late has paradoxically been coming from the stock markets, even the US stock market. I've also come to realize that everything I learned in Econ 101 and everything my dad has taught me about prudent investing would have indicated that from mid-April to the present, US stock and bond markets should have collapsed or been on a wildly volatile ride. But in the event, they have been creeping upwards, slowly, incrementally, with quite limited volatility. This phenomenon points out a contradiction to my overall disorder thesis, and I am the first person to say when I'm wrong. I actually like being wrong. I have alleged that one of the principles of the global enduring disorder is that neo-populist leaders, and we're talking the Orbans, Farages, Malonis, and Trumps of the world, actively seek to increase disorder, to harm their domestic opponents, to frighten their populaces, to keep them in power. But it would appear that there is one very important example where neo-populists don't want disorder. They seem to want order, and that's in their stock and bond markets. Even in the U.S., as Trump threatens Jerome Powell, he tries to intimidate him to lower interest rates. He tried to remove Lisa Cook, but the courts keep Lisa Cook in power. The markets have been saying, nothing doing here, nothing to see, everything is hunky-dory. So I asked, why so much order? Why hasn't disorder spread when there has been inconsistent messaging about how much tariffs we're going to get, when they're going to come on? What do these overall developments reveal about the state of mid-21st century economics? And why do non-Americans keep putting their money in the U.S. market despite Trump's actions, even if they do dollar hedges? In other words, they invest in the U.S., but they hedge it to the rate of the dollar. To try to order this disorder, this tangled knot of questions, I'm joined by Katie Martin. She is the markets columnist at the FT, who is also the host of the excellent Unhedged podcast. Welcome to Disorder, Katie.
Yeah, thanks for having me. You've got such a good set of questions there, and I'm not sure I know the answer to any of them.
Well, let's take it with my silly one. Ever since mid-April, I've been buying UVXY every week. And every week it goes down and never spikes.
Volatility has been exceptionally and surprisingly low since that shock that we had at the start of April. But let's try and unpack a little bit about what's been going on. Like, first of all, the recovery that we've had in US markets since that big shock in early April kind of flatters to deceive. Right. So it looks like there's been this massive pickup in US markets. And to be clear, there has. We're back at record highs. But a few things. First of all, if you strip out a really small number of really successful tech stocks, then actually the rest of the US stock market is just not performing that well. Nvidia, the really big tech names, they're absolutely off to the races. But the vast majority of the US stock market is kind of really plodding along. The other point is, sure, US stocks have recovered, but they're not doing anywhere near as well as stocks in most of the rest of the world. I think the US is still trailing behind the UK. For reference, that's bad. UK markets are just absolutely reliably drab and boring. So to be doing worse than the UK is not great. And thirdly, and really importantly, you bring up the issue of dollar hedging, and that's very important. So global investors are still putting money to work in the US, but they are hedging out their dollar risk like crazy. And that is the market's way of saying, okay, fine. The US is home to the fastest growing, most successful companies on the planet, particularly the really big tech stocks. We still want exposure to fast growing companies, but we are really worried about, well, firstly, that US interest rates are going to come down for a variety of reasons, some of them more valid than others. And secondly, we're really worried about institutional credibility and resilience in the US. And so the fact that if you look at European markets on a dollar basis, they're absolutely screaming ahead and are doing so much better than the US. So things are not quite as rosy in the States as it looks.
Very much agreed. Two things. Do you agree with the assertion that if we would discount the growth of data centers for AI in the States, that actually the US would be in recession? That's point one. And point two, do you agree that the tech stocks that are going gangbusters, the big seven, would be going gangbusters independent of if there had been no tariffs or if Harris had won the election? In other words, the growth of these tech stocks and AI is entirely an autonomous variable to the decisions that the new administration has done.
Now, the extent to which US markets are reliant on the AI trade is a matter of very live debate. The vast majority of capital expenditure by big US companies is going on AI, it's going on building out data centers, it's going on the chips. Everything's all kind of part of one trade, right? And to me, that's somewhat worrying because, we had news out Chinese government doesn't want Chinese companies to buy any more NVIDIA chips. So, you have these single points of failure, and I would say that the AI trade is one of them that to me should be giving investors more pause for thought than it necessarily is. There's a lot riding on this idea that this one big theme, AI, really can save the day. And also, it's important to bear in mind it's not just public markets that are affected here. If the AI trade falls over for whatever reason, the technology doesn't live up to its potential, it proves to be difficult to monetize, it proves to be a big boost to the companies that use it and not the companies that are producing it. There's a number of things that can go wrong with the AI trade. Private markets are also stuffed to the gills with this stuff. If you look at private equity, if you look at venture capital, if you look at private debt, they are also all in on this one big theme of the AI trade. So there are lots of reasons, if you want to find reasons to worry, you can find plenty of them in the AI trade.
I would like to pick up on your last point about private versus public. This may seem like a niche point, but we love us some nerdiness here on the Disorder Podcast. I have noticed in my lifetime a trend to greater asset allocation to private companies relative to public companies. So what does that mean, my dear mega orderers? There are companies like Cargill, the Koch brothers companies, others, which are not listed on stock exchanges, but it doesn't mean that you can't invest in them. These are quote unquote private companies. And some mythical time, like around when I was born in 1980, compared to just now, overall asset allocation in private companies relative to these public companies has increased. And then the private companies probably are giving back better returns, which is why people are willing to put their money in them. But the regular Tom, Dick, and Harry, or your pension fund, they struggle to get in on those deals. They're deals for insiders. So we like to explain what the new normal is, and that normal might be disordered. Could you unpack to us why there is this trend? What does it mean? What does it tell us about the global economy? And is this a trend which is bad or unfair for regular people?
So the shift in emphasis, I guess, from public to private markets has been one of the really big kind of tidal forces in global finance over the past kind of decade and a half. There are certain companies out there that have always been, say, family owned or are owned by a series of partners, like a lot of the kind of commodity trading companies and whatnot. And, they do their thing and they eat what they kill, and fair enough, they don't place too many demands on the rest of the financial system. But there's also a lot of smaller companies out there. Let's rewind a little bit. After the financial crisis in '08, interest rates were cut to zero. This absolutely led to a boom time for private equity companies. So if you're one of these big buyout firms, you can borrow money super cheaply. You can buy companies that have got beaten up valuations.
I think our listeners need to know, what is a buyout firm?
So private equity companies, the likes of KKR and Blackstone, and there's loads of them out there. They're not exactly sort of shadowy organizations, but they're not necessarily household names to everybody. But what they're able to do, or certainly what they were able to do after the big financial crisis of 2008, was to borrow money incredibly cheaply, go out there and buy companies that were looking pretty beaten up or had quite low valuations. And the kind of mythical origin story with these guys, if you like, the sort of hero story with private equity, is that they buy up little companies, they turn them from being, rinky-dink, not necessarily terribly successful companies, into whiz-bang, very well run, very well managed companies, and then they sell them again at a huge profit. And people who are investors in the private equity funds share in those profits. Now, there is two ways that they can sell them. One of them is that they can sell, say you bought a retailer, they could sell it to another retailer and you have a merger and everybody's happy. Or you can list these things on public stock markets and you get a great valuation for it, and this kind of just makes money rain down from the sky. A couple of things have gone wrong with this equation for private equity over the past 5 years since the COVID pandemic. One of them is that interest rates are much higher, so it's much more difficult. They have to pay much more money to borrow. And the other is that public stock markets have become quite gummed up. If you're a private company and you're doing pretty well, for a lot of them now, the conversation around, do you want to list on the stock market? You get to ring the bell at the New York Stock Exchange, you get to list your stocks. It creates this huge wave of money heading in your direction. Now companies are looking at it and thinking, well, I've got private equity owners. They kind of look after me pretty well. I can't really be bothered with the regulation and the reporting and all the rest of it that comes with listing on a public stock market. Maybe I'll just stay private. And so it's getting increasingly difficult to make the case for listing on public stock markets. And private equity owners are perfectly willing to hold on to these portfolio companies for longer, for as long as they can kind of squeeze the juice out of them.
Can't public firms have also gotten low or 0 or 1% interest rates, bought companies and spun them out?
Yeah, it was certainly easier when central banks cut interest rates to pretty much zero after the big crisis a decade and a half ago. It was easier for private equity firms to borrow and buy up other companies, and it was easier for companies to borrow and buy up other companies. But it just became, especially when stock markets were quite volatile and companies found it a little bit difficult to think about whether we really will make a great fortune out of listing on public markets. When you have market volatility, when you have higher interest rates, that's just a much more unfriendly environment for private equity firms to be operating in. And the idea with private equity as well is that if you invest in private equity, you expect to be able to get your money out at the end of the process within a certain period of time. Maybe that's 5 years, maybe that's 10 years. For a lot of end investors now, this is coming due and they're saying, okay, we'd like you to get out of these companies and give us our money back now, please. And they're not getting the valuation that they think they deserve. The private equity companies are saying, right, we want to list this thing on the stock market, say we think it should be worth $1 billion. And investors in the public stock market say, well, I'll give you 500 million for it, effectively. You have this disconnect. You have this unwillingness on the part of private equity firms to accept that their exit costs might be somewhat lower than what they've been hoping. So private markets are quite gummed up. What you're left with is a public stock market that's shrinking over time. Companies, quite often decide to delist of their own accord and to go private and not to bother with all of that regulation and reporting that comes with being a public company. So I guess that shrinks the pie for the rest of us whose pensions and investments are sort of hinged on the public market. It reduces some of the depth, and again on the margins it leaves us all much more reliant on this tiny clutch of US tech stocks that are doing so fabulously well.
Of course, what you're pointing out here, Katie, is something that we all experience in our life. Inequality has increased, and those who own assets and wealth have an easier time turning that into more assets and wealth, and those who don't have assets and wealth have difficulty paying their bills at the end of the month and getting on that ladder, right? So we've seen that again in our lifetimes, is the increasing inequality and the growth of very privileged jet-setting elites. You've written in the FT that everything going on in the markets pretty much everywhere is all about Trump. And on the Disorder podcast, we like to find a through line from what's happening in Ukraine and Gaza and Iran and climate change. And it's true. Trump has bestrode the globe like a colossus because his allies and enemies are all reacting to him. We might like to see the European Union reacting to him more in unison. There are so many reactions. So I would like to draw out things Trump has done. The tariffs, announcing them, then putting a 90-day pause, then having them come in at lesser rates than he said he was going to, negotiating with countries one at a time, signaling out people like Brazil or Switzerland for worse treatment if he doesn't like things they do, punishing some of our allies like India while rewarding some of our adversaries. I want to ask you, is there anything coherent about Trump's economic policies? Because looked at from 20,000 feet, it appears to be he reverses himself a million times. But maybe looked at from 80,000 feet up, it's all about deregulation, lower interest rates, and allowing infinite amounts of created new money, whether it's in crypto or the lower interest rates, to just slosh through the system. Let me know. Am I onto something with that analysis?
So we spent a good amount of time here at the FT in the early weeks of Trump's second stint in the White House, trying to do exactly what you described, trying to draw an intellectual thread and say, what is it that ties all of this together? Does anything tie all of this together? Or is this a jumble of contradictory policies that make no sense in isolation or alongside each other? We ended up coming down on the side that a lot of policymaking is spontaneous. It does quite often conflict with itself and with other pieces of policy. So then the question is, okay, is chaos the point? Is the chaos deliberate? Is the chaos there as a negotiating strategy? Or is it an unpleasant side effect of poorly thought through policy? I struggle to believe that the chaos is deliberate. I think the worldview of Trump is something like what you described, right? He has been a tariffs man since the 1980s. This is not a new fixation for him. He strongly believes in pushing back against imports and in favor of manufacturing at home. He's always been a low interest rates kind of guy. This kind of comes with the territory of being a property magnate. And he's always been a deregulation kind of guy. So these things have been constants through the past few decades. These are not new ideas on his part.
But that doesn't make them coherent.
It doesn't
Merely
make them
repeating
coherent.
something vis-a-vis Japan in the 1980s and then rejiggering it for China in the 2020s doesn't make it coherent.
It doesn't make it coherent. Also, so one of the things that the administration is very proud about at the moment is the enormous levels of tax revenue that's coming in through the tariffs. Now, that's kind of a whole bundle of contradictions because it gives lie to this idea that the foreign countries are paying the tariffs. It's very obvious that the US is paying the tariffs because they're ending up in US tax coffers. But also, to me, it's difficult to celebrate the money that's coming into the Treasury from the tariffs and also claim that there's some sort of grand renaissance of US manufacturing going on here, because the two things can't be true at the same time. If there was a renaissance in manufacturing going on, and by the way, if that were really the objective, then you probably wouldn't be arresting hundreds of South Korean workers in Hyundai factories, in the States. That's a separate issue. But the two things don't square up. So whether the chaos is deliberate or not, I think we'll probably never get to the bottom of. But one thing that really sticks out to me from certainly what's happened over the past sort of month or 6 weeks or so is like the lesson of all of this is that bullies do actually prosper, that bullying wins. It's a successful tactic. And it's very difficult for investors actually to navigate, because one thing that you really have to remember is that the president can give thumbs up or thumbs down to any company whenever he wants, for whatever reason he wants. So you could find yourself holding a stock that craters 30% tomorrow on the whim of the president, or that stock could go up 30% tomorrow on the whim of the president. You have very little way, unless you have some sort of insight into the inner workings of his brain. It's very difficult to figure out which side of that you're on. So it's a perilous environment for companies and for investors and for central bankers, frankly.
Well, it's neo-medieval, Katie, because institutions don't matter. The whim of the president to either extort or extract transactional deals, or to reverse course at any moment. The king sneezed, ergo, we're changing the relative price of gold and silver. Ergo, we are launching this war. Ergo, we're getting 15% of NVIDIA's sales to China. What I now want to zoom out is, what are other actors doing? Europe. You've written about how it's time for Europe to act together and harmonize not only its capital markets, but to join forces for borrowing. This concept of blue bonds. I want to explain to people, we've seen a response like this in the defense sphere. Trump says, maybe I'm going to withdraw from NATO, maybe I'm not going to support the Ukrainians anymore. And did they do enough? Maybe not. But there is a European Joint Defense Procurement Fund. The French and the Germans have allocated trillions to it. Britain gets to participate in this European Defense Fund. So they've done something. Could you explain to us, when these tariffs were first threatened in March, then came on in April, and now have been off and on negotiated over the summer, what have the Europeans done en masse to change how they coordinate the economic policies of the Eurozone, and then the Eurozone and its allies like Switzerland and Britain?
Mm-hmm.
And where are we at in terms of the rest of the democratic world bonding together to be able to speak with one voice? I mean, I frequently speak about the fact that Mark Carney should be the mega orderer-in-chief. He should be able to rock up to the White House and say, I don't just represent these 35 million people in Canada. I'm here on behalf of the 600 million people in democracies that are not America. We, the undersigned, including Chile and Japan and whatever, we do not accept the current statement, and we would like to see why. And we've all harmonized our monetary policies and our trade policies. I don't get why they haven't made their own block, as it were. So explain to us what has happened, what could be happening.
Yeah, there has been a certain element of every man for himself after the announcement of the global tariffs in early April, right? So individual countries, including the UK, have fallen over themselves to try and strike bilateral deals with varying levels of of success, right? So as you indicated earlier, Trump has taken exception to Switzerland, of all places, and slapped a gigantic tariff there. He's taken exception to India, despite decades spent between India and the US on solidifying
And
relations.
despite the fact that Modi is potentially ideologically aligned with Trump.
Yeah, meanwhile, Pakistan, the country that has, nominated Trump for the Nobel Peace Prize, suddenly finds itself getting more favorable treatment on tariffs. It is all quite capricious, and it does all hinge on what appear to be special interests. So, look, in an ideal world, yes, the rest of the world would act as one to push back at Trump's tariffs, and to take issue with his foreign policy. But the world doesn't work like that. It's difficult enough to get the EU, which is a pretty harmonized set of 20-something countries. It's quite difficult for them to act as one. You do have more Trump-friendly elements within the EU. You look at Italy, you look at Hungary. So it's very difficult to derive consensus.
And this is the global enduring disorder problem, Katie.
Yeah,
I have said since 2011, countries are less good at coordinating than they once were.
it's
Canada
true.
and Norway may both want to decrease carbon emissions. It's more difficult for them to coordinate how they're going to do their carbon taxes than it was in the past. So, yes, Trump has exposed what we already knew, which is the Italians and French can be on opposite sides of a hot civil war in Libya. So, of course, it's very difficult for them to agree on how they're going to respond to tariffs because they're training militias in Libya to kill each other. But what have they done? If you had to summarize, has this coordination begun to happen?
Well, it has, as you mentioned, on defense. So, Europe has, very much accepted the criticism from Trump that it was not paying its way in NATO and that it has not been spending enough on an individual country basis on defense. I think even people who are not aligned with Trump's politics can see that he does have the thread of a point there. And in the face of an increasingly hostile Russia, it is incredibly important that Europe bolsters its defences. Now, there was a really interesting chart that did the rounds a few months ago that shows that the further away a country is from Moscow within the European Union, the less it spends on defence. So Spain and Portugal, plenty far away from the Russian border. They don't spend very much on defence at all. You get up to the Baltics and Poland and Finland, and they know which side their bread is buttered. They've got a border with these guys. You do have elements of disunity there, but there is a real drive within Europe to really bolster defense spending and to act more as a common bloc against Russia, particularly with this less cooperative stance coming from the US. One of the things that's interesting to me, because I'm a markets nerd, is that for years Europe has gazed upon European financial markets and said, well, isn't this a shame that they're not as big and dynamic and as exciting and as harmonized as US financial markets? Wouldn't it be nice if the euro was a more important reserve currency than it currently is, and it could properly rival the dollar for that global status? Now, it has stood back and admired this problem for the past couple of decades. But since Trump got back into office, the sense of urgency in Europe around insulating its own markets from US risks and its sense of opportunity in really making the euro ready for prime time has massively picked up. And what we're seeing now is not just people sitting around and stroking their chins and talking about how terrible it is that the euro doesn't have much more substantial common issuance. So we're seeing more kind of meat on the bones around how that might be done on a kind of scale sufficient to be used as a reserve currency globally. We're not there yet, but we're getting there.
Great, and it's fine if it's incremental. I wrote an op-ed with Brendan Sims in the New York Times back in 2014 when the Russians invaded Donbass and annexed Crimea. If this wasn't an existential threat enough for the Europeans to make a joint defense force and to move more towards a United States of Europe, then they're never going to get there. And Putin will try to take the rest of Ukraine. My assertion, and I've said it on the pod in February, if Trump's threat of haphazard tariffs and trying to pick off the countries one at a time is not enough to get the EU to become truly a United States of Europe with joint bond issuance, harmonized capital markets, and pretty much a unified economic approach, then nothing will be. In other words, if this has only spurred them to incremental things, and those incremental things don't get them to the full union, then they're never going to get there. So the question is, great, I'm okay with incremental. What about the next increment? What is the next thing? You know, you're sitting in Germany, you're Merz. He's the most important player, probably. What does he need to do to ever so slightly nudge further in the right direction?
Well, I think you can argue that Friedrich Merz is already doing that, right? You know, what we saw earlier this year is that Germany abandoned decades of very austere fiscal policy. You know, they do not like borrowing, they do not like spending. They've completely thrown that rule book out of the window and are doing an enormous splurge of infrastructure spending and defense spending. And interestingly, they're very much banging the drum for buy German, you know, within this. They're becoming, you know, champions of German industry at a government level. This is very un-German. This is very un-European. But what it says is, you know, we've got the memo. We understand that we have to do things differently. And they are potentially showing a way forward for other members of the Eurozone and of the EU. The problem is that the banking industry in Europe remains incredibly disjointed. Not
Can you
so much on
explain why?
So, funnily enough, I was just talking to a senior banker about this earlier today, and he was saying, okay, so maybe we raise deposits in Germany from retail customers, and we want to use those funds to make loans to commercial businesses in Spain. No, the regulator in Germany will say, no, we need these funds. If they come from retail, we need them to stay within Germany. You can't just be taking them across
Because
borders.
there isn't a United States of Europe.
Because there isn't a United States of Europe, and because every individual country has its own tax and spending rules. It has its own solvency rules. They all have different ways of judging when a company has or hasn't gone bust and what happens to it next and who gets the payout and who
So
doesn't.
the Chapter 11 laws are different in Germany and Spain.
It's a total patchwork. All the different states have their own, and also I think everybody accepts in Europe. Look, there's too many bloody banks. There's too many banks in Europe. But if you are running, if you're the French government, you want there to be a French national champion or two or three. Everyone can look at their own stock exchange and say, well, of course Europe's got too many stock exchanges. What we need is fewer stock exchanges. But obviously we need to keep ours. There's too many banks, but obviously we need to keep our banks. There's too many rules, but obviously we need to keep our rules.
You've expressed this very clearly, and I want to underlie this for the mega orderers because it goes beyond just the issue of financial integration in Europe. During the enduring disorder, it's very difficult to harmonize on standards because no one who has a vested interest ever wants to give up on his own standard. So you tell the New Zealanders you should drive on the right-hand side of the road. They say, no, but the Australians also drive on the left. So it's very difficult. You have a different plug. Wait, we should all move to the same plug. No, I don't want to. The British have a different plug. Why should we give up on our different plug? And to my mind, this is a huge problem in moving towards global governance because there is no neutral institution. In other words, there's no one sitting above the Germans, the Belgians, and the Spanish who could tell them, we're going to make a standard which is neither of your standards. My view, though, is why can't the ECB be that, or the Council of Europe? Can't it impose things on the countries?
Obviously, monetary policy, so interest rates are set at a centralized level at the European Central Bank. So you still have a Banque de France, you still have a central bank in Germany. They do other activities, but they don't set interest rates. The interest rates are set centrally. But a lot of rules for banking are effectively sent down from the sky in Brussels by the EU as directives. So this is the framework of what we want you to do. The national government is still responsible for figuring out the small print and implementing it. And so it's incredibly frustrating for bankers in Europe. Now, if you're a big company, then you are very able to go to, a bank anywhere in Europe and have it sort out for you a really big bond issue that will go to lots of international investors. That wholesale bit of the markets works pretty well, actually. But when you get down to the nitty-gritty of the retail level and being able to slosh deposits around the whole of the EU, it gets much more complicated. And this is a real source of frustration. So about a year, in fact, almost exactly a year ago, we had a report out from Mario Draghi, who used to be the president of the European Central Bank. He was prime minister of Italy. And he wrote a report saying, look, Europe is badly falling behind on competitiveness. We've got to make banking slicker. We've got to be hungrier in terms of global competition. We've got to play to our strengths. We've got to stop being so frightened of what America will say about everything. And everybody smiled and nodded and said, yes, we'll get on with implementing all of your proposals immediately. And then a frustratingly small number of those proposals have really been acted on. So he gave a speech the other day in which he was saying effectively, for the love of God, can you please get on with this? We're still falling behind. So I am I'm pretty optimistic that Europe can see that if not now, when? Now is absolutely the time to do that greater integration. But sometimes when I speak to people on the ground involved in like the banking industry and whatnot, I think, God, we're just not going to get over the line here.
Talk about the UK gilt market. I remember when the gilts to treasuries, and now gilts are British bonds, just as treasuries are American bonds. I remember when the spread between the gilts and the treasuries was something which made the pound very expensive, even though the UK economy was not doing particularly well. And I'm wondering if we're there at this place now. The pound is at 1.36. That seems very expensive to me. That's close to pre-Brexit levels. But the UK economy is not doing great. Why is it that the pound can be at 1.36 and you have this spread between the gilt and the treasuries? You have written on an FT column that we will share in the show notes and the Substack, and I quote, "In global debt markets, the UK is the canary in the coal mine, the perfect example of the reckoning that may be coming for governments hooked on other people's money." Can you explain why?
So to go through the points that you raised there, one of them is around the level of the currency. As you say, the pound's trading at about $1.36 now. By historical standards, it's gained a lot over the past 12 months or so. But
11%.
But at the point at which we had the Brexit referendum, it was trading at about 1.50. I remember it getting as high as $2.10.
Well,
So
$2.10 is when I first got into Oxford in 2008. So let's not. It hasn't been above 1.9 since 2010, and it was at 1.46 or so before the referendum. But
yep.
Since after Brexit, it hasn't really been north of 1.37. Yep. This is really the highest. It's the highest since 2018.
It's the highest it's been in a fair while, but it's not quite at nosebleed territory yet. But the level that it is at, if it's gained 11% this year, guess what's fallen 11% this year?
The dollar.
It's the dollar. And so that's why even with all of the chaos that's going on in French politics, the euro is still holding pretty high. So the worst performing major currency in the world this year is the dollar. That's the bit that's taking the strain. If you look past the stock market, if you look past even the government bond market, it's the dollar that's telling you something here is not right. That's the way that markets are expressing this unease over US policy at the moment. Now, again, the US has this exorbitant privilege, right? It has this ability because it's the world's most important economy, because it's got the world's most important currency. It can get away with stuff that other countries can't get away with. So investors are nervous about things. They buy the most liquid thing they can get their hand on, the thing that's easiest to buy, that there's lots of, and that's US government bonds. And that's proving to be quite a hard habit to break, you
Why are
know.
people not afraid that, if Trump led to Vance and Vance led to Howley, that the U.S. would become Argentina in default?
So the problem with a lot of these scenarios that you can game plan in your head if you really want to is that the way I think about it is you can't be a little bit pregnant, right? So either the Fed is independent or it's not. Either the data is reliable or it's not. Either capitalism is allowed to do its thing and let companies rise and fall depending on their skills and wit, or that falls apart. It's quite difficult to price grey zones. It's quite difficult to price that in-betweeny thing where the administration is tinkering with the Fed but not taking it over. I was asking some investors about this the other day. They were saying, look, they think there's a reasonable chance that we do get a total breakdown in central bank independence and in US institutions. The thing they were looking out for to tell them that this is really happening right now is that inflation breaks higher and the Fed does nothing about it. That is the point at which I think the rubber would hit the road for the US is if we did get,
Inflation breaks higher
yeah,
and the Fed does nothing about it.
in terms of
Meaning,
meaning that the Fed doesn't raise interest rates to try and calm
yeah, because
inflation
Trump
down.
is he's all about low interest rates. What you're talking about is the Turkey scenario. In other words,
Exactly.
if central bank independence were truly gone and we
Yeah.
were in Turkey or
Yeah.
Orban land,
Hmm.
then they would keep interest rates low even when the moment had come that you have to rise them.
Exactly. Exactly.
I want you to help me understand something about the relationship of neo-populists who are also neoliberals and the bond markets. Neoliberalism confuses me in some ways because it would seem to me that the commodification of everything would at some point be too much, and there would be too much debt and too much credit, and that the markets would push back. And yet, when Trump made his big, beautiful bill, which is a handout, it's a neoliberal handout to billionaires and companies and less regulation, the markets ate it up and they were happy. Italy has had only one neo-populist president, Giorgia Meloni, and in her tenure, the economy is doing well, and the bond markets are responding better in Italy than they are in France. And that's historically, an aberration. So does this mean that my economic vision about what's wrong about populism is either A, wrong, or B, not shared by the markets? That markets seem to like giving huge tax rebates to the wealthy, and they're happy with what to me would seem to be fiscal incontinence or a lack of rectitude, because when we see that lack of rectitude both in Italy and in the US, the investors say, great, this is fine for the markets. I'm not worried.
Look, markets love tax cuts, especially for companies. They love low interest rates. They love deregulation. They love all of these things. The problem is that, so for example, the UK left the EU. There was a lot of people, myself included, who thought that, okay, day one, there's going to be a gigantic crash in markets and then it will just keep on crashing. Now, there was a gigantic crash in markets on the night of that referendum. I remember it very clearly because I was pulling an all-nighter at work.
So do we all.
Yeah, they were strange days. But markets bounced back. But what we've had in the UK ever since our exit from the EU is just sand in the gears. It's just friction here and there. It's a loss of status and it's an extra burden of paperwork. And that has quite a long tail, right? It takes a long time to play out. I suspect a similar thing is going on in the States. You had a shock, you had a pullback from the president in some of his core policies, and this will reverberate through the US economy, not just for 3 weeks, but for decades. This is a loss of status. This is a loss of credibility that will be very difficult even for the next administration to get back. So just because there isn't a continuing bin fire going on in the US stock market does not mean that there's no long-term damage inflicted by the administration.
Well, I want to try to simplify this point. As I understand it, and I'm not an economist, tax cuts and deregulation are things that markets like in the short term, but when overdone in the long term, they either lead to bubbles that then collapse or corruption or unsustainability. In other words, we have seen a situation in the US and the UK where we have sold our children's futures down the river for our asset prices and housing prices and things to go up now. Am I missing something?
Look, I think we all have to be humble in how we assess what's happened this year. It is an undeniable fact that markets and companies have proven much more resilient to this change in regime, if you like, in paradigm from the US than we would have expected. There is a possibility out there in the universe that Trump is right and that his economic policy makes perfect sense for the
I'm super
short
interested in
term.
that. Explain what would that mean about the laws of economics or the new normal. Explain to us what it would mean if Trump is right.
So, maybe we do live in a world in which super low levels of regulation, super low interest rates, and aggressive trade tariffs, maybe that does actually pay off for the US and lots of other countries try it too. This is not what economists are necessarily expecting, but I think we have to accept that as I say, the system has proven much more resilient. The
And what
flip
would that
side,
mean, though? What would that mean if that was the case?
well, it might mean that other countries were tempted to try the same things.
But
And
it might only work for the US.
again, I come back to my suspicion, which is that it only works in the States. And it only works in the States because you have this hegemonic financial
So,
power.
am I correct in saying Trump was right that the US has so much power, we can go around as a mafia warlord and say, I'd like my protection money? And that then the polls go, great, we'll spend 5% on defense and we'll buy more of your Lockheed Martin things. And the Brits say, sure, we'll do this for you. And then the Swiss say, to get us off the tariffs, of course, we will help in this way and we'll give you this. And that there was a way in which we were underwriting a less mercantilist order. But if we wanted to get a mercantilist payout, we could go around with our cap in hand and collect our protection money.
There is every possibility that Trump gets away with this effectively through the whole of his time in office. The flip side of this sort of analysis is, first of all, as I say, it can take a really long time after a big explosion like this for the bodies to rise to the surface, right? It can take a really long time for the adverse outcomes, if there are any, from this policy agenda to really become clear. The other, particularly in relation to, say, US interest rates, look, the US economy is in decent enough shape that it does not make sense to cut interest rates to like 1% in the US. But if the Federal Reserve were to do that tomorrow, then sure, the stock market would love that short term. It would rocket higher. This is cheap borrowing. This is free money for everybody. This is an environment that stock markets love. But the way I've always put it is it's a little bit like wetting your pants at the North Pole, right? You feel lovely and warm at first, and it's a huge sense of relief. And then you freeze to death later down the line. And so, you do have long-term consequences that are not immediately obvious. And look, when I talk to
In this case, they're
investors,
actually quite obvious.
well, not necessarily straight away. When I talk to investors, they say, look, this has been a hideous shock that's come our way from the US. We weren't expecting the president to have this geopolitical stance, this economic stance, any of this stuff. And long-term investors say, look, whoever comes in at the next presidential election. We can't do this every 4 years. We're not going to trust the US the same way again for the next few decades, because you could have a MAGA president every 4 years. You could do this to the rest of the world pretty much ad infinitum. And that's a real concern for managers of long-term money. And that's why the dollar is weaker. It's why government bonds are a little bit weaker around the edges. It's why there is more vulnerability.
This has been an excellent overview of the state of the markets from circa January 20 to mid-September 2025. In our Ordering the Disorder segment, we like to propose some policy ideas that could bring greater order to the world. I mentioned Britain.
Mm-hmm.
Britain, it has the English language. It has highly skilled financial professionals sitting in the city and in East London. What can Britain do on the global stage to make more order and stability? Can it propose regulatory requirements? Can it mediate between the US and the EU? Can Starmer use the visit that Trump is on in the UK as we're recording as a way to set himself up as a mediator? What would you like to see the UK doing that it is not?
I think the useful role that the UK has already provided here is being a galvanizing force in helping to coordinate across Europe on defense and on Ukraine. You know, our relationship with Ukraine is incredibly strong, and we've, proven that as a country we can bring together other important leaders across Europe to demonstrate a show of strength and a show of support for Ukraine. And the other thing is absolutely this mediation thing, this bridge between the US and Europe. Is this a stable relationship? No. Could we find ourselves out of favor with the US tomorrow? Of course we could. But for now, that relationship appears strong. We share a lot of common interests on defense and on intelligence, and these things matter. This is not for nothing. So that's probably what the UK can provide here. But you are sort of dealing with a US leadership that you're carrying a very delicate vase, and you don't want to drop it, and it could smash at any minute. And it is very difficult for policymakers here, for civil servants, for diplomats. It's a really huge challenge, but it has to be worth it, worth the effort to try and keep that relationship between the US and Europe alive.
Okay, on a political sense, I get what you're pointing at. What about, though, when it comes to the bond markets? Because going back to what you wrote, in global debt markets, the UK is the canary in the coal mine. The perfect example of the reckoning that may be coming for governments hooked on other people's money. Order the disorder with me there. What does this mean in terms of UK government borrowing?
It's really important that governments everywhere, not just in the UK, but across Europe and also in the US, realize that there is less demand for long-term government debt everywhere, partly because of changing demographics that just mean there is less of a need to buy really long-term bonds. Governments have got to find a way to either cut spending or make their economies grow faster to provide the funds that they need to provide essential services. You can't just keep leaning on pension funds and insurance companies and think that they will continue to push money out in your direction, no questions asked. When you have a more inflationary global economy, and that does seem to be the case since the pandemic struck 5 years ago, governments have to work harder to keep global investors on side.
2 final questions, rapid fire.
Okay.
If you were advising the Europeans, so we've talked about the Brits, what should the Europeans do to provide more financial stability and to push back against Trump's tariffs, to assert that, hey, actually, we're a bigger trading bloc than the US. The US may have more wealth, it may have more stocks, but we import more stuff. What should they do to assert themselves?
The way for Europe to assert itself here is to get on with it and issue joint debt. Just find a way to make this happen. And look, the first iteration of it might not be perfect. It might have some kinks that need ironing out. It might put some national capitals' noses out of joint in the process of doing it. These might not be perfect bonds, but I think Europe suffers from letting the perfect be the enemy of the good, and it should get on with issuing joint debt, because investors would snap this stuff up.
I love it. From your mouth to God's ears, you have ordered the disorder. The final question that we love to ask all of our podcast guests: if you could create one global financial institution to order the disorder, what would it be?
I guess it would be some sort of internationally recognized body that has a focus on inequality. And I guess you could argue the World Bank does that already, or the IMF does that already. But, the US is an economy where you have, the US Open tennis tournament, someone was telling me yesterday they were selling caviar chicken nuggets for $100 a pop to punters at the tennis. It cannot be right that you have an economy where that is a thing, where you have such grinding levels of poverty and drug addiction in other parts of the country. There has to be some way to, at the very least, strongly encourage countries to bring inequality into line. Problem is, you can't mandate different tax policies, for example, to effect change, but there has to be a greater focus on inequality, because that's what gives rise to a lot of the populism that ends up being so corrosive to long-term economic growth.
I love it. I think that we need that institution. It has been a real pleasure for me today to be chatting with Katie Martin, the FT's markets columnist, who is also the host of the Unhedged podcast. If you enjoyed today's show and want to hear more about what Katie thinks about markets, please follow the link in the show notes to some of her articles and content, or even better yet, subscribe to our Substack, where I'm going to put 3 really interesting articles she has written about the gilt market, what the Europeans are up to. And the really weird thing is that despite Trump's assaulting institutions, it's like the frog boiling problem when it comes to markets.